Hello and welcome to the 2017 tax year. In this video, I'm going to run through things to be aware of as you pull together your 2016 tax returns. I'll also go through tax changes that have recently been legislated and what the election result might mean for individual taxes. It's been a pretty quiet year on the individual tax front, with few substantial changes for salary and wage earners. Tax rates remain unchanged this year, with the top tax rate of 45% kicking in at $180,000, along with a temporary budget repair levy of 2%. If you participate in an employee share scheme, you'll notice the reporting of this income has become more transparent. A new box on your statement shows whether your employer is reporting the gross share scheme income, being the total discount received from the ESS event, or the assessable income, which is your employer's calculation of the assessable amount based on your known travel days or assignment dates. Your employer can also now include your assignment dates on your statement. As always, if you report an amount on your tax return that differs from what's on your ESS statement, the tax office is likely to request more information. The tax office has advised that it will be focusing on rental properties this year. If you have a taxable property in Australia or overseas, it's worth reading the rental property guidance issued by the tax office. The most common issue involves repairs and maintenance, specifically the distinction between genuine repairs and maintenance, which can be claimed in full immediately, versus improvements to the property, which can be claimed over a number of years either as depreciation or as a special building write-off. The tax office will also be looking at work-related expenses. For work-related car travel deductions, the tax office has said it may go as far as confirming with employers whether an employee is expected to use a car for travel. They will also be looking at the reasonableness of deductions for mobile phone and broadband expenses. The only major legislated tax change affecting individuals is a new 10% non-final withholding tax on the acquisition of Australian property over $2 million from foreign residents. This applies from 1 July 2016 and requires some upfront planning and research. If you're an Australian tax resident selling Australian real estate over $2 million, you'll need to obtain a clearance certificate from the tax office to ensure that no amount is withheld from the proceeds. You can apply for the clearance certificate online on the ATO website. If you're a non-resident for tax purposes selling Australian real estate over $2 million, you'll need to determine whether any resulting capital gain is taxable. Capital gains tax may not apply if you're selling your main residence or if you have capital losses available to offset any gains. You can then seek a withholding rate variation. Again, this can be requested online. If you're the purchaser of Australian real estate, you will need to consider whether you withhold any amount from the purchase price and remit it to the tax office. A government has now been formed, so our attention turns to exactly how and when any proposed tax changes will be legislated. Given the composition of the government and the Senate, it's unlikely that the coalition will have an easy ride getting their flagged tax changes passed. What ends up getting legislated may look quite different to what was proposed. The main tax changes outlined before the election for individuals involve superannuation. For people in the contributions phase, there is a reduction in the concessional contributions cap to $25,000 per year and the introduction of a $500,000 lifetime non-concessional contributions cap, which will likely affect potential transfers from foreign pension funds. On the positive side, it is proposed that you no longer have to salary sacrifice amounts to super to receive the concessional rate. You can simply make a contribution yourself and claim a deduction in your tax return. For higher income earners, the income cap that applies for the additional 15% contributions tax on concessional contributions will drop from $300,000 to $250,000. For the pensions phase, a superannuation transfer balance cap will be introduced, limiting tax-free income within the fund to $1.6 million. The Coalition proposed some small tax rate changes and the abolishment of the temporary budget repair levy from 1 July 2017. It's certainly an interesting time, and there are many taxpayers, industries and advisors who are keen to see exactly how tax policy will change in the next term of government. That's it from me today. Thanks for your time. Feel free to contact us if you have any questions.